Welcome back. Previously, we were dealing with preparation of fund flow statement, and today we will discuss about some of the adjustment and cases that comes under the same category of problems. Next case. Gamma Limited has furnished its balance sheet as on the date will be given, and some of the additional informations are as follows. During the year 2015, the land was revalued. A dividend of rupees 10,000 for 2014 was paid in July 2015. An old machine was sold for rupees 3,000. Depreciation of assets for during the period is given. And finally, provision for tax paid during the year rupees 5,000, and provision for tax made during the year is 15,000. You are asked to prepare the fund flow statement of the company. A comparative balance sheet of the concern is given. Liabilities and assets for the 2 years is given. And regarding the adjustments of this case, one or two adjustments might have been heard previously and some are new. We will discuss about each adjustment in detail on the course of the computation. So as we all know, in order to prepare a fund flow statement of a concern, first of all, you need to prepare schedule of changes in working capital. That is the first step during the preparation of fund flow statement. So schedule of changes in working capital, and we have done numerous cases regarding schedule of changes in working capital, and you all know how to prepare a schedule of changes in working capital. You have to be very familiarized with the statement and the pattern in which a schedule has to be prepared. And this was the balance sheet question or the comparative balance sheet which was given in the question, and on the basis of details given in the balance sheet you need to prepare schedule of changes in working capital. And for your convenience, I am just mentioning, whenever you are preparing a fund flow statement, you need not have to worry about additional information while preparing schedule of changes in working capital, except in one case. Sometimes in that adjustment they might give you need to treat some specific items as current asset or current liability. That is the only type of adjustment you may deal with while analyzing these type of questions. Usually adjustment need not has to be considered while preparing a schedule of changes in working capital. You just have to go through the balance sheet given in the question. But remember, there is one type of adjustment that will affect schedule of changes in working capital. In this case, there is no information regarding like that. We will discuss that part in the future sessions. So, for preparing schedule of changes in working capital, we all know it has to be begin with the details regarding particulars, the year or the time given in the question. Remember, you have to specify it properly. First column, particulars. After that, you need to write down the first year given in the question, followed by the coming year. After that, increase in working capital, then decrease in working capital. Every schedule begins with current assets. So, on the basis of details given in the question, you know what are the items that comes under the category of current assets. And first of all, let's start with stock. So we will write down stock. In the first year it was 15,000. In the second year it was 20,000. So there is an increase of current asset, and we all know the rule. What led to increase in working capital and what leads to decrease in working capital. Here there is an increase in current asset, so increase in current assets leads to increase in working capital, and remember the difference has to be written in the corresponding column. Since there is an increase in current asset, it is shown in the increase in working capital side 5,000. Next asset, debtors. In the beginning it was 30,000, after that it came to 40,000, that is again there is an increase in current asset, so you need to show the difference amount in the increase in working capital column. I hope you all know what is the rule for allotting the amount, difference amount in the increase as well as decrease columns in the schedule of changes in working capital. I am not explaining it again and again. Finally, it is the cash and bank. In the beginning it was 40,000 and by the end it was 65,000. So again there is an increase in current asset and the difference amount has to be shown in the increase in working capital side. So we have recorded almost all the current items in the schedule of changes in working capital. Once you're done with current asset, you just need to take the total, and remember you need to take the totals of the year columns only, that is first and second column. Once you've done the total, just next you have to record the current liabilities, and in the liability side if you go through it you can see that there is only one item, that is current liabilities as 10,000 and 13,000. So you need to just record that item only. So current asset in the beginning was 10,000 and by the end there was 13,000. So there is an increase of rupees 3,000 during the year. So whenever there is an increase in current liability, you know how to record the same amount and where to record the difference amount in the schedule of changes in working capital. So there are no further current assets or current liabilities in this question. So once you have done with recording all the items in the schedule, next you need to take the totals of these two. So we have the total of current assets as well as current liabilities. So just you need to take the difference between current assets and current liability, then you will get working capital. And remember you need to take the difference of these two totals only. 65,000 minus 10,000 you will get 55,000 and 95,000 minus 13,000 you will get 82,000. Sorry about the total. If you take the total of these two, you will get 85,000 and 1,25,000. And once you're done with current assets, now you will deal with current liabilities. Since there are no other amount, let this 10,000 and 13,000 be the total of current liabilities. Next, you need to take the working capital, that is the difference between total of current assets, this amount, and current liabilities, this amount. Since there are no other amount, you will consider this 10,000 and 13,000 as total current liabilities. By taking the difference, you will get 75,000 and 1,12,000. Once you found out the current working capital, you need to take the difference of these two. These two means just like balancing a ledger account, you need to balance these two sides. By balancing these two sides, you will get a difference of 37,000 in this side. And once you deal with this part, you need to take the balance of this side also. Here also you will get a difference of 37,000 in this side. So your computation will be correct if you are getting a difference of 37,000 by balancing these two columns and again 37,000 by balancing these two columns. These two separate has to be balanced, balancing has to be done separately for these two sets of columns. So once you done that, you will get increase in working capital, and you all guys know what is the meaning of increase in working capital and how we are going to get. If there is a higher value in the increase in working capital side and there is a smaller value in decrease in working capital, then the difference amount is considered as increase in working capital. That is the concept. It's quite simple. So once you have done with schedule of changes in working capital, next you need to prepare various non-current accounts. And the question was this one. And on the base, usually non-current accounts are prepared on the base of additional information, and there is one peculiar case in which you need to prepare non-current accounts even if there is no information given the additional part. We all know that part, that is proposed dividend as well as provision for tax. And for all other non-current accounts, if there is information given in the additional information like this here points have given, then only you need to prepare non-current accounts. So let us deal with the additional informations. First additional information was given during the year 2015, land was revalued. Land may be revalued. Land may be revalued higher. It may be revalued to a higher value or it may be revalued to a lower value. It doesn't matter. The concept is that whenever a land is revalued, you need to make sure the details given in the question whether such a revaluation leads to a flow of fund. And if you look closely to the details given, During the year 2015, land was revalued. So if you go to the land amount, at the beginning it was 10,000 and by the end it was 35,000. So it's quite natural. So the amount has been revalued to a higher amount. So a revaluation of 25,000 was done during the year. So far so good, but you need to make sure the details given in the question. In the liability side, if you go through it, you can see that there is an item revaluation reserve, 25,000. So sometimes the details may not be fully given in the question. The question it is said that land was revalued and no other information. Whether it was revalued, whether that revaluation led to flow of fund, there is no information like that. And in the question, if you go through it, you can see that a revaluation reserve of 25,000 was made during the year. So the concept is, during the year, land was revalued. We all agree that. But the revaluation amount was transferred to a general reserve. So the concept is, all these transactions doesn't affect a flow of fund, because we have learned at the beginning that there are some transactions that cannot be considered as a flow of fund. Whenever a transaction consisting of one current item and another non-current item, then only a flow of fund occurs. Here land is revalued. Here land, we all know it is a non-current item, and reserve also a non-current item. Since both items are non-current items, the difference cannot be considered as a flow of fund. So the meaning is that the first adjustment need not have to be considered during the computation. You may come across questions like this, so you have to be very cautious while dealing with such cases. Okay, first adjustment is over. You need not have to worry about it. So you need not have to record it. It doesn't mean that all the information has to be recorded like that. Analyze each question, understand the additional information given, make sure whether there is any flow of fund occur or not. If there is flow of fund, you need to record that transaction. If there is no flow of fund, you need not have to worry about it. So first adjustment is neglected. We need not have to record anywhere during the computation. Second part, dividend of rupees 10,000 for 2014 was paid in July 2015. The meaning of the sentence is, dividend has been paid. And if you go closely through the liabilities and assets or the comparative balance sheet given in the question, you can see that there is an item proposed dividend 10,000 and 12,000. As I have said earlier, even if there is no information, you have to prepare a proposed dividend account. So since there is information is already given in the question, so let us prepare a proposed dividend account. And we all know, first of all, you need to note down the opening balance as well as closing balance. The opening balance is 10,000 and closing balance is 12,000. And in the question it is said that dividend of rupees 10,000 for 2014 was paid in July 2015. It means during the year, dividend was paid. Whenever a payment occurs, the entry is dividend account debtor to cash. So let us record that amount to cash 10,000. There are no further information given in the question. So let us balance this account, because we all know there are only 4 items in a proposed dividend: opening balance, closing balance, to cash, and finally there is only one item that has to be taken on the base of, by balancing this account, you will get a difference of by P&L 12,000. Even if there is no information regarding this 10,000 given in the question, still you need to prepare a proposed dividend, and you know how to prepare that. In that case, you need to shift the opening balance as to cash and the closing balance as by P&L. It's an assumption. So next adjustment is given: an old machine was sold for rupees 3,000. So it's just a sale of an asset. But in the question it is given, original cost of the asset was 10,000 and written down value was 2,000. So let us prepare a machinery account. So before preparing the machinery account, you need to understand that the value of the asset or the cost of the asset will be the original cost or the acquisition cost. It will be given. If you deduct depreciation from this original cost, you will get the book value. Here it is written in the another way. If you deduct book value from original cost, you will get depreciation. And the concept is whenever you deduct depreciation from original cost, you will get book value. And the concept is that whenever there is occur a sale in asset, you need to compare the sale price with the book value and not with the cost. So in this case, original cost, if you deduct depreciation, you will get book value. So in the question it is said that original cost is 10,000 and written down value is 2,000. Written down value means the book value is known as written down value. So if you take the difference of original cost and written down value, you will get the depreciation of the concerned asset. That is a hidden information. Remember that when original cost and written down value is given, it means you will get depreciation if you take the difference. And whenever sale occurs, you need to compare the sale amount with written down value or book value. Then only we can understand whether there is profit or loss. So when the book value is greater than sale price, there will be loss. And when the book value is less than sale price, there will be profit. We all know about the concept of loss and profit like that. So before we go into further, remember in this question an old machine original cost 10,000, 2,000 as I said earlier. If you take the difference, you will get the depreciation amount. Remember always, whenever you are dealing with a fund flow statement, you need to understand and familiarize all the additional information given in the question. As per the information given here, the difference between these two means depreciation, as we have discussed now. So if you take the difference between 10,000 and 2,000, you will get 8,000. So depreciation of that machinery is 8,000. All those informations are correct. But if you go through the adjustments thoroughly, you can see that in the next line it is given depreciation on assets was provided during the year, and for various items is given building 600, machinery it is 12,000. Remember previously I have said that if you take the difference between original cost and written down value, you will get depreciation, and that depreciation has to be recorded as depreciation on machinery. But in this question, in the next line it is said that depreciation on machinery is 12,000. So which amount has to be taken? That is an issue you have to face while dealing with the question in the examination. In the absence of this information, that is depreciation asset, if this information was not given in the question, the depreciation on machinery was 8,000. Since in this question an additional information which was specifically mentioned that depreciation on machinery is 12,000, in that case you need to take this 12,000 instead of 8,000 here. You have to remember this rule. I hope you understand the concept. So let us prepare the machinery account. We all begin with the opening balance as well as closing balance. First of all, let us record the opening balance. The machinery opening balance 1,40,000, closing balance 2,20,000. And in the information it is said that old machine is sold for rupees 3,000. So let us record the sale amount 3,000. Once you record the sale amount, you have to analyze it whether it is sold for profit or loss. And how we are going to find profit or loss? It is the difference between sale price and the written down value. Here written down value was 2,000, but it was sold for 3,000. That means there was a profit of rupees 1,000 on that sale. And next item has to be recorded is depreciation. And I hope you all now understand the concept of depreciation I have mentioned earlier. So the depreciation of machinery will be 12,000. See, 12,000. If this information, that is this fourth adjustment, was not given in the question, the depreciation might have been 8,000. In that case, it will be 8,000. Since it is specifically said that machinery is 12,000, in that case, you have to consider that 12,000. Remember this concept. Okay. By balancing this account, you can see that this side is higher and this side is lower. That is, there is a difference amount is found in the left hand side of the machinery account. So whenever you are dealing with a fixed asset, especially machinery or a building or a land, etc., whenever you are dealing with a fixed asset account, whenever there is a difference in left hand side or the debit side or right hand side, whatever the side it doesn't matter, the difference has to be considered as cash. So in the left hand side, if it is a difference, it is considered as to cash. To cash means it is a purchase. So purchase, it is 94,000. If it was a difference in this side, it would have been by cash. That means there was sales during the year. That is a concept of preparing a machinery account. This is how you have to deal with a machinery account or a fixed asset account. So we have done the third adjustment. Let us go to the fourth adjustment. There is a depreciation on assets, building, machinery, furniture. Whenever there is a depreciation detail given in the question, you have to prepare the concern accounts. And in the first one, that is building. So let us prepare building account. There is no further information or issues regarding building account. So you just need to show the opening balance as well as closing balance. Opening balance is 15,000, closing balance is 17,000, and in the question it is said there is a depreciation during the year, building rupees 600. So by depreciation 600, and by balancing you can see that there is a difference in the sides. So there is a difference in the left hand side. As I have said earlier, whenever you are dealing with a fixed asset account, the difference is considered as cash. Since it is in the left hand side, it is considered to cash, that means purchase. That is the meaning of that concept. So we have done with buildings, and next one, machinery. We have already dealt with machinery. Next you need to prepare furniture account, because depreciation on furniture is given. So again, another fixed asset, you have to begin with its balances. Opening balance is 20,000, closing balance is 23,000, and depreciation during the year is 2,000. Still, if you go through the ledger account, you can see that there is a balance or difference in the left hand side. So it has to be considered as a purchase. If it was in the right side, it would have been a sale. That is the concept. So we have almost dealt with all the four adjustments. And last but not the least, provision for tax. Even if there is no information regarding provision of tax given in the question, or that is in the additional information, if the provision of tax is found in the balance sheet, you have to definitely prepare a provision for tax account. It is a rule. Even in the question it is already given, provision for tax, and remember it's an adjustment and it's a very important adjustment. Just go through it. First of all, let us record the opening balance as well as closing balance, because it doesn't need any information. Let us write down opening balance 20,000, closing balance 30,000, and next the adjustment is very important. Just go through it. Provision for tax paid during the year 5,000, and provision for tax made during the year is 15,000. You may find it very simple sentence, but it has two different meanings, two different concepts. Means provision for tax paid during the year means, as the sentence which we have read down, tax paid during the year. Remember, it is said provision for tax paid. So whenever you pay something, the entry will be the concerned expense account debited to cash. Since tax is paid during the year, we can write that provision for tax to cash 5,000. Next sentence, you have to be very careful. Provision for tax made during the year. You may find these two sentences or these two structures, information may similar. You may find it similar, but the concept is one is paid during the year, the another is made during the year. The made during the means provisions are usually paid as well as made. The two are different. Paid means you are paying something. Made means you are set aside some amount out of profit so as to meet somewhere in future. So here provision for tax made during the year means by P&L 15,000. You may find it very simple, but during the examination you have to make sure when any of these two information will only given. In this question, I just made an alteration to show these two items in order to discuss this concept. Usually, you will be given only this one or the second part. So you have to analyze it very carefully. If it is said that if it is paid during the year, it has to be recorded as to cash. If it is given that provision for tax made during the year, in that case you need to record it as by P&L. By taking the balance, you can see that both sides are equal. So this is how you have to deal with preparation of non-current accounts. Non-current accounts are prepared on the basis of additional information, just like the points given here. And only two items, for two items you need to prepare accounts compulsorily, that is proposed dividend and provision for tax. We have dealt both the case here. Proposed dividend and provision for tax is given. At the same time, there are additional information given in the question. Even if there is no information regarding proposed dividend and provision for tax, you have to prepare these two accounts, proposed dividend as well as provision for tax. Remember those concept and rule. Once you have dealt with preparation of non-current accounts, next you are preparing fund from operation. Here in this case, we are preparing adjusted general reserve account, because during the theoretical part we have discussed that for finding out fund from operation, you can either prepare a statement or you can follow an account. And we have dealt both the cases in the previous cases, and here we are preparing a new item, adjusted general reserve account. It is similar to the adjusted profit and loss account. And why we are giving the name adjusted general reserve account? Because this was a question which we have been discussing now. And we all know, for preparation of fund from operation, we begin with net profit during the year. Sometimes net profit may be given in the question. That is another part, we have discussed that. Sometimes it will not be given. In that case, you need to take the difference between the P&L account. So if you go through the balance sheet, comparative balance sheet given in the question, you can see that there is no information regarding profit and loss account in the liability side or in the asset side. So how you are going to prepare an account, or how you are going to find out fund from operation? Whenever there is no information regarding P&L account given in the question or in the additional information, the assumption is that you have to rely on general reserve item. In this question, general reserve is given. So we will take the difference of 40,000 and 30,000 as profit during the year. It is an assumption. Whenever there is no P&L account, you have to depend upon general reserve. And remember, once you take general reserve as the once you take the difference of these amount as the profit during the year, you never again add back, transfer to reserve as the difference amount as the non-operating expense item. You need to remember that once you take this item as the net profit during the year, you don't add back again the difference of this amount as a non-operating expense, because we have done that part previously. Whenever there is a difference in general reserve, you consider it as a non-operating expense. So since there is no information regarding P&L, we have take this part. And remember the sentence I have just mentioned earlier. Since we are going to prepare in an account form, it is named as adjusted general reserve. So it begins with, and these were the accounts which we have prepared. And let us begin with opening balance as well as closing balance. It is given in the question 30,000 and 40,000. And before we go further, we will first cover the non-current account which we have prepared. Always follow a certain pattern for computation, because it will be quite useful while dealing with the same scenario in an examination time. In that case, you might be getting tensed and you may end up getting careless mistakes. So always follow a pattern. So once you have preparing an adjusted general reserve account or a fund from operation account, first to go through the non-current accounts you have prepared. And you need not have to worry about the items you have seen here. Just concentrate on by P&L as well as two P&L items. By P&L as well as two P&L or the profit and loss account items. If you go through the first account, if there is any P&L, see here it is by P&L 12,000. So show it as proposed dividend 12,000. So first account is over. Next you have to go for the second one, machinery account. See if you can find how many P&L items. See here it is profit on sale, P&L depreciation. Okay, only choose two items. Just record it. First one, profit on sale 1,000. Since it is a non-operating income, it has to be shown in the credit side. And by P&L it is depreciation 12,000. We all know depreciation is charged in the P&L account. So depreciation. Here in this question there was 3 depreciation. For the time being I am just showing all the depreciation. So first one 600 of building, machinery 12,000 and furniture 2,000. So we have dealt with machinery, building, furniture. And if you go through these two accounts, you can see that all the P&L items are taken. Here by depreciation, it's a P&L item. Try to use by P&L and in the bracket write it as depreciation. So during the examination, it is quite easy to catch these individual items. Furniture, here it is written by depreciation. Instead of that, you write by P&L. In the bracket, it is write as depreciation. So it will be very easy to catch the individual items. Next one, provision for tax. There is one P&L item 15,000. Show provision for tax 15,000. So there are no other items in the non-current accounts. Once you have dealt with non-current accounts, just go through the question part. In the additional information, we have almost dealt with all the account because we are preparing non-current accounts on the basis of additional information. If there is any item which we haven't prepared a non-current account, try to go through it. And in here we have almost covered all these additional information. So just go through the question part. Question part, we know what are the items has to be checked in a comparative balance sheet is if there look for any intangible assets, look for any preliminary expenses written off, look for any discount on issue of shares and debentures, and any miscellaneous expenditures. So here it is general reserve is given. General reserve is an important item, but in this case we have taken general reserve amount as the opening and closing balance for the preparation of adjusted general reserve. So we need not have to take the difference amount. Next one, revaluation reserve. It is a reserve, correct, but here 25,000 is acquired by the revaluation of a fixed asset. So it doesn't result in fund flow statement. So we are neglecting it. Depreciation, proposed dividend, current liability, provision for tax. And in the asset side, there is no other information. So let us balance this account. By balancing, you can see that left hand side is having a higher value unlike the right hand side. So there is a difference. So in the right hand side, it is considered as fund from operations. Once you prepare fund from operation, next you need to prepare fund flow statement during the year. And we all know left hand side is sources, right hand side is application. Let us begin with this fund from operation. It is a source of fund, so written in the left hand side 50,600. And remember, while preparing fund flow statement, you just begin with schedule of changes in working capital, because the balance in the schedule of changes in working capital has to be shown in either of the two sides in the fund flow statement. And while preparing schedule of changes, we got that increase in working capital was 37,000. So whenever there is an increase in working capital, it is an application fund. So it is shown in the application side. Next, you need to go through all these non-current account. You can see that, and for non-current account, what all items has to be taken. Remember, for preparation of fund flow statement, if you are going through the non-current accounts, remember you just have to look for to cash and buy cash items. Because we are preparing a fund flow statement in which we are considering only the flow of cash or bank. First account, proposed dividend. Here you can see that there is to cash of 10,000. So dividend paid 10,000. It is an application. When payment is done, it is an application. So first account is over. Next one, machinery. You can see that there is one sale as well as purchase. And we know what is the meaning of sale and purchase. One is source and another is application. So first one, purchase of machinery 94,000, since it is a purchase, application of fund. and there was a sale of rupees 3000, so it is shown in the sources side. So machinery account is over. Next one, buildings account, you can see that there is only one cash item, that is in the debit side. It means purchase, so it's an application of one purchase of building 2600. Next one, furniture account, again you can see there is a cash in the debit side 5000, so again it is a purchase of fund, purchase of an asset, so it is 5000 shown in the application side. And finally, provision for tax, there is only one cash item, it is shown to cash, that is tax paid during the year. Payment is considered as an application, so again it is shown in the application side. So once you are done with the current account, non-current accounts, you just go through the question part. Question part means additional information and balance sheet. And if you just go through the additional information, make sure whether you have dealt with all the informations. In this case, we have prepared almost all the accounts for the concerned additional information. So once you have prepared the account and analyzed the accounts, you need not have to again go through additional information. Either you go through this additional information or you go through non-current accounts. That is up to your discretion. In my suggestion, it is easy to go through the non-current accounts rather than this additional information, because in the additional information you may find it confusing. In the account you can briefly identify which one is to cash, which one is P&L, which one is by cash, like that. That's why I'm preferring non-current accounts. So anyway, you have to go through additional informations also. Sometimes some accounts need not have to be prepared. Some items, for example, interim dividend paid. For that, you need not have to prepare account, but that adjustment amount has to be considered in the fund flow statement. Since we are not preparing an account, you will be neglecting that amount. So remember that once you are dealt with non-current account, just go through this additional information, whether you have covered all the information or not. Make sure that since we have dealt all this part, just go through the balance sheet. In this balance sheet, you need to look for fixed assets and fixed liabilities. That is a trick for easy computation of these case of problems. Whenever you are preparing fund flow statement and if you are analyzing the balance sheet given in the question, just go through fixed assets and fixed liabilities. First of all, equity share capital. Remember whether you have prepared the account for equity share capital or not. We haven't prepared, so the difference can be considered as issue of shares, because here liabilities increase. Whenever liabilities increase, there is a source of fund. Next one, general reserve, we need not have to consider. Revaluation reserve doesn't matter. 15% debentures, make sure whether we have prepared account or not. No, we haven't prepared. So the difference is, at the beginning there was nothing, by the end there was 50,000. That means liability has been increased during the year. Whenever liability increases, there is a source of fund. So issue of debentures 50,000. Proposed dividend we have dealt with. Current liabilities is already recorded. Provision for tax also completed. Land account has been, we haven't prepared. The adjustment regarding land, we have discussed that part. It doesn't affect our computation. Buildings we have already prepared. Machinery also prepared. Furniture also prepared. And the remaining current assets has been dealt in the schedule of changes in working capital part. So we have almost included the amounts which we have found in the question, as well as the amount which we have generated while preparing non-current accounts as well as fund from operation. So if you take the total of these two sides, you will get an amount of equal amount in both sides, that is 1,53,600 and 1,53,600. This is how you have to prepare a fund flow statement, and make sure whether you are getting a tally amount. Usually you will get an equal amount. Whenever there is any difference, just go through all the information you have gone through. If you have missed any points during the computation part, just go through it. Analyze each and every point. The concept all are simple, but because of the inclusion of different informations and different points which has to be remembered, you might skip some of the points. That may lead to issues and errors. So just go through it, understand the concept, familiarize each and every step. We will discuss about the further cases and adjustments that comes under fund flow statement in the coming sessions. That's all for today. Thank you.